G'day and welcome to the Investor Motivation Podcast. Welcome, Amy Lehman.
I'm back again, everybody.
Cool. My name's Robert Gowdy, and today we're going to have a bit of a chat about the evolution of financial advice, evolution of what we've done here.
Yeah, the way we invest, why we do invest the way we do, and how that has changed from the beginning of our investment journey to now.
Yeah, and we just had a quick lunch, and we started to talk about the industry and thought, geez, this is what we need to be recording. So we'll follow on from the lunch catch up to into here. But before we get going, let's tackle the acknowledgement of the land. Tackle's probably the wrong word.
No, I'll gladly do it.
Good,
on behalf of the Investor Motivation Podcast, I would like to acknowledge the traditional owners of the land on which we record this podcast and pay our respects to elders past, present and emerging.
Fantastic. And when I say tackle, some of the Watchabolic, the Jardi Jabwa is some of our local Indigenous names, so pronunciation is often the tackle.
Good job.
Yeah. So let's have a bit of a chat. And I suppose just the history, people know that obviously I've got a fair bit of age on Amy. I've been in this industry for 25 years and I've seen a lot of change. And even for your, how many years you've been in the industry now for, Amy?
3.
3. All you've seen is change?
Yeah.
Yep. So where this conversation started was really around ETFs, and do we chat about ETFs compared to and managed funds and compare that to direct investing and things like that. So that's where it sort of started off, and we thought it would be well worthwhile to talk about the evolution of the business, because I've essentially considered all that in the past.
Yeah.
Yeah.
And even I didn't realise, I thought it was just an evolution of, in my opinion, I think a lot of people start with managed funds because they're accessible, they diversify your investments straight away, and then, the more money you have under management, then you can select the stocks a little bit at the individual level and go direct. But as we discussed over lunch, I didn't realise back in the day that actually managed funds was all you had.
Yeah, you're really the only, for myself as a financial advisor, particularly a 25-year-old guy, green, new to the industry, that was all you really had. If you wanted to go and buy, CSL or something directly, you had to go to a stock broker and pay brokerage and all that fun. Yeah. So it was either...
And that was an actual stockbroker, individual person, not just a stockbroker website.
Correct.
For us,
yeah, that's right. You had to make a phone call, and my brother and I used to trade options back then, and it was physical. Pick up the phone, talk to someone, and then they would action your instructions. They'd ring you back to say it got done. Yeah. So we're talking late 90s there, so it's really not relevant for today's discussion. But
no, I just think that's interesting though. That was never an option really for you to do easily.
No, and really the way things have progressed, and how our business has changed here has been based on technology providing us a lot more options to invest in what I believe is a really client-friendly way to do it, and an interesting way to do it as well. Not just about it's not just about fees. It's about control. It's about transparency. There's lots of things. And I need to acknowledge that we use managed funds. We use exchange-traded funds, which are ETFs, and we'll go over those. None of that is wrong.
No, we're definitely not saying something's definitively good or definitively bad and you should do it, but we're going to weigh up the pros and the cons and why we choose what we choose to do now.
Yeah, and so I think the starting point, again, following on from lunch, was when I was chatting to Amy, I said, look, many years ago, we were colonial. So there used to be the life insurance agents. There was AMP people running around and selling insurance policies. MLC, Colonial, AXA, Colonial, and I worked in and bought a Colonial book. Yeah. And so eventually Colonial got bought out by the Commonwealth Bank in 2000. Yeah. So the Commonwealth Bank financial advisors then had the same products that I was using. Yeah. And so I used to say to people, look, all the financial advisors all have the same apple to sell. Yeah. The same apple by me, Commonwealth Bank and myself, product. It was exactly the same thing. We both had Colonial First Aid First Choice. Yeah. Where My brother down the road, they sold a product which is very similar. Same Apple again.
Yeah.
It's a competitive industry. The fees, the options, the features are all essentially the same. And I'd say it gets down to who do you trust?
Yeah, the individual advisor.
Correct. You have to obviously have deep trust for someone to look after your money. But over time, I noticed there was some things in the managed fund world that wasn't really client friendly.
Yeah.
And one of those, I think there's a few things that annoyed me. If we invested for a client any time in June, they would receive the distributions of income and capital gains that was realised for the whole previous financial year.
Yeah.
They would receive that distribution, which hurt their tax and also hurt Centrelink outcomes.
Yeah.
So they were there for a heartbeat, but copped these, negative capital gains outcomes. So a managed fund could be going for 30 years. And if you're there the day before June 30, they could realise all the capital gains that's been accumulated over 30 years now, one financial year.
Yeah.
You're the new kid on the block, you cop that.
I think I might, just while we got into it all already, but just take a step back and explain what a managed fund is to people that don't know, because you're correct. A managed fund is essentially a investment where you can buy into it as an individual, but your funds are pooled together with a whole lot of other investors' funds. So you don't own the underlying assets within the fund. You are into a pool of investors, and that fund manager buys and sells the assets within that fund, and it affects every member of that asset. Yeah.
Thank you for that, Amy.
So that's why you don't get to select when you're buying in or buying out, because you're just buying a unit of this fund.
Correct.
Yeah.
And ETFs, which are very similar to managed funds, are largely the same, but they're traded. They're an exchange traded fund.
Yeah. So you can purchase that where you would also purchase direct shares.
Correct. So managed funds are often unlisted.
Yeah.
ETFs, are listed on the stock exchange globally.
Yeah.
So these products are really good business. They're built for scale.
Yes.
So you set up one structure, and so Amy and I set up the Amy and Rob Australian Share Fund. Mm-hmm. Investors can invest into that fund. This is hypothetical. We don't have a fund, and there's no conflicts. So
purchase our fund.
Yes. Everyone, we can put 100 people there that own units, or 100,000 people. So it was extremely efficient for fund managers, for the banks, for the product manufacturers.
Yes.
So it worked really well there, but quite often if you were coming in 10 years after it's set up, and there's all these unrealised capital gains, and they just happened to realise it had a negative effect on taxation, and for some of my clients, Centrelink.
Yeah.
And I remember that this is going back to, and I think live examples are always good, Amy, where I happened to pick, by luck rather than good management, bit of both.
Credit credit's due.
Well, I knew that there was the build up to the second Iraq war. This is 2000, sort of early March 2003.
Yeah.
So we had the tech wreck. That there was a bear market for a long time. That's where leading up to 2000, the American, the internet bubble, burst. And so it was a tough market for 2 or 3 years. And then there was the build up on the Kuwaiti border with the US military ready to go into Iraq.
Yeah.
And I look back to when Bush Senior, as president of the States, once they went to war, once they knew they were at war, the share market took off.
Yeah.
So the build-up was the uncertainty. Are we at war? Are we not? Well, we don't know. So that was uncertain. And as soon as actually went to war, guess what happened?
Improvements.
And I think that might have been 8, 9, 10 March 2003.
Yeah.
I took out a margin loan. 80 grand, it was a big deal. I was borrowing money to invest. And luckily, good luck, good management, combination of the two. I got it essentially right.
Yeah, and sorry, you invested in a managed fund? In
a managed fund.
Yeah.
It was Colonial First Aid into a managed fund. I can't remember if it was Aussie Equities, I think it was.
Yeah.
And then so that was start of March, so less than 4 months later, we're at the end of the financial year. And the capital gains that was realised during that year that I copped, and I was there for less than 4 months, was huge.
Yeah.
I thought, that's not fair.
Yeah.
And that sort of, obviously was one of the experiences where I thought, well, I'm sick of looking like all my competitors. Here's the same apple.
Yeah.
And then I had that experience where it affected my tax outcome, because the fund managers are busy studying the businesses, trying to provide the best advice, talking like Warren Buffett, long term, long term.
Yeah.
And then they're buying and selling, triggering the capital gains.
Yeah.
And so, so they say one thing, then do the opposite. And that's obviously their job, but they're not aware of Robert Gowdy's personal tax outcomes.
They're doing it for the overall capital growth and gains of that fund, not the individual in there. Yeah.
Correct. Yeah, they can't ring up 10,000 people saying, what's your tax look like for this year? Or do we wait till you retire next year?
Yeah.
So it just can't happen at that personal level.
Yeah.
And that's probably where, one, I didn't want to look the same as everyone else. And I said, this is going back 20 years. And I thought, right, how do we invest for people where you've got control, you know what you own, and obviously going direct was clearly that option.
And you can select when you want to incur those losses or gains.
Correct. If we've got some gains,
we
can say, well, where's something in the portfolio that I got wrong? And that can be sold to offset the gain.
Yeah, you can tax plan, and that's extremely important.
Correct. And we can be truly, like Warren Buffett. Now, no one's going to have the patience that Warren Buffett has, but it does allow us to invest and invest for a long time.
Yeah.
Because I've seen fund managers, nearly bragging about how, they sold, and the one I'm thinking about is Altium. We sold Altium at $12.50. And, the recording, the timing of that recording was fine, bragging about it, selling at 12, now it's at 11. 8 years later it's at 38.
Yeah.
So, Warren Buffett says the ideal investment time is forever.
Yeah.
And often when I talk to clients, it's about owning, the businesses that we purchase, because we need to give management time to build, improve services, improve products. We need to give them the time. It's not 6 months, it's years, it's decades, it's the rest of our life. And if we do that well enough, it can last a very long time.
Yeah.
And the performance can be good over a long duration.
Yeah, it's kind of like compound investing in a bank account. Your investment stays there and it accumulates and accumulates. The same with any business that's operating efficiently. It's only going to get better and better and bigger.
Yeah,
and grow.
And whilst that company might pay out dividends, you say, I haven't got dividend reinvestment where dividends are not received by the investor, they're reinvested back into the business.
Yeah.
While it may not have dividend reinvestment, they may only pay out 30, 40, 50% of the profit they make, and they keep what's left and reinvest.
Yeah.
So there is a form of dividend, compounding and reinvestment back into the business.
Yeah. All right, well, now that we've kind of talked about all the cons of managed funds, maybe we should spit out a couple of pros.
Absolutely. Well, some of the pros is that, one, young investors with very, $500 or less can go and buy the S&P 500 in the US.
Yeah. I think that's definitely one of the biggest selling points is those starting out and you don't have the time to all the funds to diversify and select the eyes out of the market. You can just buy into a fund and it does the top 500 stocks.
Excuse me. So that is definitely, definitely one of the pros to it, and it's and I think for those that want to do that, and you want diversification because you just don't want to, because I don't want particularly young people to go and buy something and it turns out to be a dog.
Yeah, you put one $500 purchase in because that's all you've got and that goes down.
Yep. It goes into the cannabis stock, it goes into the crypto or whatever left field thing it is. It's the hype at the time.
Yeah.
And you get that bad experience where you say, well, I'm never going to the share market ever again.
Yeah, so obviously Rob mentioned the S&P 500, so that would be the top 500 stocks in America. So, if one investment out of that 500 goes down, it's not going to affect your holding greatly.
Obviously, it gives you can get exposure to a broad range of asset classes. We've mentioned the share markets, but it can be property that is on the stock exchanges, infrastructure, cash and fixed interest. You've got all these different asset classes that you can give you diversification.
Yeah, so that's even if you're probably more conservative than the S&P 500 investing just into the share market. You can choose a managed fund that may have a growth risk profile, and 70% might be invested into shares, and then the other 30 may be invested in cash, term deposits, government bonds. Yeah, a myriad of things, and that just reduces your exposure again, protects that money.
And a lot of the ETFs, there are hundreds, if not thousands out there that you can jump on different investment themes. You want to go something that just invests into robotics, just into healthcare, just into blockchain.
Yeah, ESG only.
Yep.
Yeah, anything.
All out there.
So that is a great thing, and they are professionally managed as well. So if you don't have the time or you don't have the actual want to do your own research, it could be a great option for you.
Absolutely. What else, Amy? Another benefit of managed funds. We've been negative about the tax on managed funds, but you can, the S&P 500 that we mentioned, that would be an index fund. They don't have high turnover, buy, sell.
That's true.
So that wouldn't create the tax problem that I mentioned earlier.
Yeah, that's a good point.
So easy to trade, easy to get in, easy to get out of. I think that's the share market in general.
Yeah.
In Australia, when we purchase today, Friday, our purchase or sell, the transaction settles on Tuesday.
Yeah.
T+2.
Yeah.
So incredible. You'd be in and out whenever you want.
Yeah, that's shares and managed funds. They'll both, if the managed fund is on the stock exchange, it'll be that quick. But if you are purchasing directly through the asset manager, it may take longer.
Yeah. If you've got to fill out an application online or any type of an unlisted managed fund, slow process.
Yeah. And it's also probably worth noting that if you are going to purchase a managed fund or an ETF, that there's always going to be a product disclosure statement that you should read, which will tell you the asset class or the theme that you're investing in, as well as the fees. I don't think we've really talked much about the fees, but there will be a management cost, an admin cost, and performance fees generally on those. Yeah,
and I think that reading the PDS or understanding the product where you're investing is really important. The reason why recently we've seen some of these smaller property trusts, they're unlisted, and redemptions are limited to 2.5% of the fund each year. And one thing that I'm quite sure that my client didn't know about, there is close to 50% worth of gearing of debt within the fund. So while the story about the product and where they invest is nice, there's all these different risks where you actually can't get your money out if you wanted to. By the time they pay out estates and things like that, the flexibility is not there.
No.
So
it probably just on those fees again, the performance fees and the management fees are ongoing fees each year. They're not just a once-off, a buy and sell cost. They are every year you'll incur that fee. Whereas obviously if you're buying into direct shares, it's just your initial brokerage cost and no more ongoing. So
correct. Unless our services, which we have both, but I love the direct side. We don't make money on brokerage, but we have ongoing service fees. So different models between stockbrokers might be just transaction based only, but they've over the last 10 years moved to more of the model that we use here. Yep. So now I had an important point to mention, and it's gone for the moment. So let's keep going. It will come back at some stage.
Right.
I'm sure.
If we just keep talking, it may come back.
Yeah, we'll see how that goes.
All right. Well, let's talk about, I suppose, the direct side of things, and I might leave this one for you to explain, which you already kind of have, but why this is the preference and why we've moved more towards this.
Yeah, I think at the starting point, things that annoyed me were tax. I wanted control over the tax outcomes. And I also knew that to buy managed funds, you use wrap accounts and master funds, I used to be called, but let's say wrap account like a Net Wealth or AMP North or MLC something, or there's lots.
IWF something,
Correct. There's just lots of products, and products essentially all had fees. So there was lots of snouts in the trough. And that's how, just so clients understood it. That's how I sort of phrased it. There would be
The product.
there'd be the product administration.
Yeah.
There would be the managed fund.
Ongoing performance.
Correct.
Admin.
Then there would be our fee as a financial advisor. So there was a lot of people
Yes.
nipping at the fees. The way that we changed things was, hey, we don't need product. If it's a big self-managed super fund, if it's a super fund, we might go for a self-managed.
Yeah.
So yes, we pay for accounting fees. You pay for advice, strategic structural advice,
Yeah.
and investment advice ongoing. And I was able to get rid of the product, the platform, the wrap account, and also the funds management fees.
Yeah.
Now, with of course no promise that what I recommend, and that's a big part of my job, I recommend where to place people's money, what asset class, what businesses do we own,
Yeah.
and that's why I've always said that we like to invest into businesses that we love, and that's the Apple phone, it's the Microsoft. We've got a Microsoft Surface computer in front of us.
Yeah.
We buy Microsoft as a core base in all of our portfolios. What a
Yeah.
magnificent company.
One of the best businesses in the world.
Yeah, and I find that part, the bit that, yes, the tax is good, reducing fees because you don't have the other snouts in the trough, you know what you own. And
You're interested in it.
Yeah.
You use these products every day.
yeah, it makes sense to me. I want to know what I own. I've been in business for 25 years, so there might be an element of control freak, but I just find it more interesting rather than managed fund where I'm in the balance option.
Yeah.
Where's your money? Don't really know.
Alternatives.
Yeah.
Yeah.
So it's not for everyone. And I do encourage my clients not to obsess about where their money is or what it's doing in the short term. I want them to go out and have fun. We've spoken about that in length. Go and do the stuff that makes you happy. If watching the share market is stressful, stop looking.
Yeah.
Yep. So there was the fee saving side to it as well, where I cannot guarantee we would outperform, but if I could say we'll save you $4,000 a year, every year for the next rest of your life, that is something you can lock in.
Yeah.
Because fees have an impact. And so when we provide advice in the managed fund world, we try to keep things pretty simple. We use exchange trade funds or managed funds, which are index based.
Yeah.
Vanguard, iShares, which is BlackRock. They are not expensive.
No, and that's just a big diversification thing
Yeah.
as well.
Yeah, not all people are self-managed, but where it's just in people's individual names, we do a lot of company, trust, joint, individual holdings where it's outside of super.
Yeah.
And I love to go direct.
Yeah, and I think it's also probably worth noting that over the years you've built up preferences of asset classes you wish to invest in and businesses you wish to completely avoid, and going direct
Correct.
allows you to do that. We don't have to go into the mining companies that we don't want to go into.
Yep.
Whereas if you are buying the index, you don't get a choice of any of the businesses you're purchasing. It's just the top 500.
Yeah. So
whatever.
I personally like to know what the companies are doing, reading their quarterly reports if it's a US, or the half yearly or yearly if it's in Australia. But of course, there's one of the cons for going direct and owning the business directly is every now and then not every now and then, there'll always be a dog in a portfolio. We'll get that wrong, and that's where very rarely they go to zero. I would say that doesn't happen, but losing 30, 40, 50, 60% in capital on that investment, that's a different discussion.
Yeah.
You don't see it within the managed funds. It's definitely happening in the managed funds, but you
Just
don't
absorb it.
it's not right in front of your
Yeah.
face. So that's something to get your head around. But the way we deal with that to reduce that overall risk is to make sure we have plenty of diversification.
Definitely.
Fees is important. Tax control, transparency, knowing what you own and why.
Yeah.
But I like to know, I can happily explain what each business does in my the client portfolios and my own.
Yeah.
Yeah. And so overall, I just find it a little bit more interesting.
Yeah, I definitely agree with that. I've never personally, even with a very minimal amount of money when I very first started investing, I always wanted to pick out, the businesses I was interested in and went straight direct and didn't go the managed fund route. But I obviously do see the value in that for people that aren't as interested.
Yes.
So yeah, it's just a time and place thing for everybody, I think.
Fantastic. Oh, yes, the one, and it was actually on the other page, the freezing of funds.
Ah,
Did I write that or did you write
you
that?
wrote that?
I wrote that. So back in the GFC, so one of the, huge crash, huge concern, the anxiety in investors was extreme.
Yeah.
But we thought the financial system of the US was just going to collapse. So it was, the anxiousness was, it was fair, absolutely fair. But there's a clause within all managed funds that they can freeze the money, which means you can't get it out.
Yeah.
And so what they did, the government, to shore up the system in Australia, provided a government guarantee on banking deposits up to 250 grand, which is still here now,
Yeah.
per entity, per institution.
Yeah.
So often when we're investing for our clients' funds and we've got your allocation of $1 million of term deposits, we'll have 4 separate term deposits with different institutions.
Mm-hmm. Just to make the most of that government guarantee.
Yeah, just in case. I don't think our banks are going to fall down,
No.
but it's what you don't see coming is what hurts.
Yeah.
But so once that came in, all of a sudden the managed funds of fixed interest, the more conservative stuff, they froze. They said you cannot get your money out.
Mm.
And it took, it's probably been a decade. I don't think we've got any left, but it was years and years where we were progressively, as we were accumulating new clients, and they might have been with BT Wrap or, so there was all these frozen funds which were just paid out slow, so they could manage the sell down.
Yeah.
So that's a negative, but it can also be a positive because it protects the money that's there.
Yeah.
Because if you have to sell it all quickly, you're talking about a fire sale, bank, sell the lot.
Yeah. They could have come up with that money and paid that out, and that's
Yep.
how economies can collapse, I suppose.
Well, it's how assets, you sell something in a hurry, you're not going to get the optimal price.
No.
So that's why that one's there, and I think it was, it worked, I'm sure, but it was also a risk, and it was also an administration, nightmare. We all had to be tidied up over the preceding years, and I'm talking 8 to 10 years.
Yeah.
It was still, some funds that were still going.
It's a lot of time to have your funds locked away.
Yeah, no access. Very good. Any other issues that we could think about? I think we've covered most of it.
Yeah, was the freezing the thing you were thinking about?
I
forgot.
think it was.
Okay, with this.
I believe it was.
Yeah, all right.
Yeah, although I won't, can't be sure on that.
It's all right.
Too old to remember. So I think that's enough for that discussion.
Yes.
The evolution of the business, exchange trade funds, managed funds compared to direct, and why we've gone down the path that we have done for the last 20 years, and it's been good fun.
Yeah.
I've outperformed the market sometimes and underperformed it in other times, but it's been an enjoyable process. Our business is administration heavy because of the way
Yes.
we do it. We're the mail house. We make it easy for clients to do.
Yeah. That's
yeah.
probably actually also another con, I suppose, for direct share investing is if you are doing it all on your own, that's a lot of, documents to have to give to your accountant. All of the dividends need to be given. If you're doing any buys and sells, they all need to be given. Obviously, we do that for clients as the mail house, but that could be a con for direct investing.
Absolutely. That's a good point.
Yeah, I mean,
Now, Amy, we had our advisor chat this morning, where sometimes we always said it gets a little bit nerdy at some of the technical stuff. What do we chat about? What's worth noting? Nothing exciting in your mind, is there? There was,
maybe the in-specie.
yeah, the small business capital gains one. So I was trying to get clarification, potentially transferring commercial property into a self-managed super fund for a client. Lots of tax benefits in doing so. It creates a lease. I won't bore you. It might be another discussion another day.
Another podcast.
But we would look to use the small business capital gains exemptions, and the ATO. This is where I don't have the answer today. This is more of a grey area.
Yeah, well, we have sought some feedback from a technical specialist, and even they have said, there's been rulings from the ATO against and rulings for, and that it's ultimately up to the ATO to decide case by case. But sorry.
No, it's all right, and it's about the actual transfer of the asset into the superannuation fund. Does that count for the super contribution under the small business capital gains exemption, the 500,000 retirement exemption, or should it be a separate cash investment?
Yeah.
Probably the conservative approach might be that, but the only reason why I brought up such a complex and grey area is that anyone that's selling a business asset, talk to your accountant regarding the small business capital gains exemption.
Yes.
We are financial advisors. We're also tax agents, but it's not our world where we live. The final advice needs to come from your accountant. Get your accounting advice.
Yeah.
And
even, I was going to say, even the accountants will be seeking independent advice at times. Some of this stuff can be extremely difficult.
Yeah, absolutely. Especially, there's horses for courses, specialist advice in that area. Some people know that area extremely well.
Yes.
Fantastic.
That's probably it.
Thank you, Amy.
Thank you, everybody.
Cool. Thank you for listening. Please shoot in some ideas, some topics you'd like covered. Go to our website. There is so much education there. Our YouTube channel has over 530 videos there. We've been at it for a while, trying to provide as much information and education as possible. So thank you for listening.
If you want to see young Rob, go check out the YouTube.
Oh, yeah. I'm not sure we should refer.
He's pioneered this.
All right. Thanks, everyone.
Thanks, everybody. Bye.
Bye.